Chapter 1, I will briefly explain the concept of investment and investor mindset. Firstly, investment. Investment is the act of putting money into asset to yield future return. It involves sacrificing current spending for future financial benefit and help individuals grow well. Common investment instruments include stock, bonds, unit trusts, and property. Next, risk versus return. Risk refers to the possible that actual return may differ from expected return, including losses. Return is the profit or loss earned from investment. Higher risk leads to higher potential return, while lower risk leads to lower return. Investors must choose investment based on their risk tolerance. Moving to investment goals. Investment goals are financial objectives that guide decisions such as how much, where, and how long to invest. Examples include retirement planning, education funding, buying property, and wealth accumulation. Lastly, investor mindset. Successfully, investors focus on long-term growth, understand risk, control emotions, stay disciplined, and continuously improve their knowledge.
Next is real assets. Real assets are tangible physical assets that have intrinsic value and can generate income or increase in value over time. They are classified as non-financial assets, are generally less liquid, and are harder to buy and sell compared to financial assets. Examples of real assets are gold, for example bullion, coins such as kijang emas, real estate, for example land, residential, commercial, and industrial properties, collectibles, for example antiques, jewelry, artworks, old coins, stamps, and lastly, machinery and equipment. Among the advantages of real assets are hedge against inflation as values tend to increase over time. It can generate direct income, for example rental income from property, and it is also a durable and stable investment. As for the disadvantages of real assets, they are low liquidity, which is difficult to convert into cash quickly. It is high initial capital required, and it also involves price risk and market uncertainty.
Next, in Chapter 2, Investment in Financial Asset. Financial asset is a money-based instrument that Malaysians can use to save, invest, and grow wealth, such as cash, stocks, bonds, and bank deposits. There are 4 types of investment alternatives in financial asset. Number 1 is securities, which has 4 types. The first is treasury bills, which offers low risk, high liquidity, and can easily be sold for cash. Second is common stock, that offers higher expected returns and potential capital gains, but with high risk. Third is bonds, which is a debt security by the government or private companies, providing income through coupons with lower risk than stocks but higher risk than treasury bills. The fourth is preferred stock, offers fixed dividends and priority over common stock in payments but with limited voting rights. The second investment alternatives is savings, which has 2 types. The first is saving account that deposits and withdrawals with low risk with modest interest, ideal for emergency funds or short-term savings. Next is fixed account, where money is placed at a fixed period at a higher interest rate than saving account but with low risk. The third investment alternatives is derivative security that also has 2 types. The first is options that gives investors the right but not the obligation to buy or sell an asset at a set price within a specific period, useful for Malaysians to hedge risk or speculate on price movements. The second is futures that contracts to buy or sell an asset at a set price on a future date, used by Malaysians to hedge risk or speculate on price movement as well. Lastly, the fourth investment alternative is unit trust funds, which offers benefits such access to professional management, lower risk through investment variety, and being able to make relatively small investments, provide Malaysians with an easy and efficient way to slowly increase their wealth.
Next, let's talk about tools provided by the market. There are 2 main types of securities market, which is the primary market and the secondary market. The primary market is where investors buy new shares directly from companies, for example, during an initial public offering (IPO). The secondary market is where investors trade existing shares with each other, such as on Bursa Malaysia. These markets provide a safe and structured platform for investing.
Next, tools provided in the Malaysian capital market. First, Bursa Malaysia act as a regulator to ensure all trading activities are conducted in an orderly and fair manner while protecting its members. Next, the Securities Commission Malaysia is a statutory body that regulates and supervises the capital market. It listens and monitors market participants to ensure compliance with regulations. The broker acts as a middleman between investors and the market, helping investors place, buy, and sell orders. Lastly, the trading platform is an online system that allows investors to trade financial products, view price, and access transactions records. In conclusion, these tools work together to ensure a safe and efficient investment environment in Malaysia.